All right, good afternoon. Hi everyone, welcome to today's webinar provided by Solarplaza, which is in preparation for our upcoming Solar Future Nigeria conference, which will be held on the 25th and 26th of April in Lagos, Nigeria. Today's currency-focused webinar is organized together with one of our sponsors of the event, TCX, and we'll be joined by MFX, Garanco, and OPIC. And they will be discussing some of the key issues on currency risk and convertibility issues in Nigeria. The Solar Future Nigeria conference will be a two-day event where we will welcome over 200 international and local stakeholders, really ranging from government and policymakers and financiers to project developers, IPPs and EPCs, etc. This conference will be the key platform to attend for all those interested and involved in the sector, and we will be covering the full solar electrification spectrum, but with a spotlight on financing and regulation in Nigeria. Basically, the breakdown is we have 1.5 days of in-depth conference sessions, and then half a day of tailored B2B business and finance matchmaking sessions. Happy to announce that the matchmaking platform that we will be using for this will be launched this Friday, so the ones that has registered for the conference can start browsing and determining who they want to meet. Co-located with our event, there will also be a side workshop organized by Power Africa on off-grid appliances on the 27th of April. This is an invite-only event, so if you want to get invited, be sure to check out the website for more information on this and on everything else that we are organizing. I would like to briefly highlight our sponsors and partners who are really helping us build this event towards a success. We're very fortunate to have such a great collection of people and organizations endorsing our event. Reason enough to join. I'm also very happy to announce that we have our Naira payment gateway up and running. So as a local company, you can now register and pay in Naira via our registration page, which is also on the event website. Now, just before we start, I would like to point out some practical things. If you have any questions or issues during the webinar, you can communicate that to us by typing in the control panel on the right-hand side where it says questions. And questions directed at our presenters will be collected from here. And we will aim to get everything answered in our Q&A session at the end. Now, I will briefly introduce our five speakers of the day. They each play different roles in the effort to support sustainable local currency funding solutions. TCX will kick off with an overview of the market and go in depth on Naira volatility and hedging options. We have Senior VP Per and his colleague Jos, VP Research. TCX is an Amsterdam-based development initiative that offers hedging products in developing markets where financial markets fall short. Then Luz from MFX will continue the session. MFX is a hedge intermediary vehicle. It's closely aligned with TCX as well by offering possibility to lenders and developers to procure hedges without collateral requirements. Then there's Suba, Managing Director at OPIC, who will provide a lender's perspective and give some insights on OPIC's activities in the region. And the final contribution will be from Dinesh, a Senior Investment Advisor at Garanco. Garanco is a development initiative based in London supporting local currency funding from domestic sources through a series of guarantee and credit enhancement products. And then at the end of all this, we will be sure to have plenty of time for Q&A. So if you have questions, don't hesitate to drop them in the chat box. Now, I would like to, before I'm handing over the presentation, I would like to give the audience the option to answer a question via our poll option. So, you see the question on screen, which is, let me see. In the context of current market developments in Nigeria, would you consider local currency debt financing for your projects if you are a solar developer? So the options are, yes, I am actually considering it right now, or I would theoretically consider it, or just a plain no. And we'll give you some time to answer this, and we will discuss the results of this poll a bit further on in the webinar. Okay, then without further delay, I would like to give the presentation to Jos from TCX. Jos, the floor is yours.
Thank you, Evelyn, and thank you for the opportunity to speak here. As Evelyn said, questions, of course, can be typed in the chat box, and I'm happy to answer those. Yeah, I'll give a short snapshot of the Nigerian economy. Evelyn, I have the rights to click, right? Yeah. And after me, Per will go into the hedging options that are available for Nigeria. So let me first start with this slide, because many Nigeria stories probably start with oil, and that has a reason, of course. Oil and oil products are over 90% of Nigeria's exports. And at the same time, all revenues, both from profit sharing and also from taxes, bring in over 70% of the government's total revenues. So the below graph is also very telling. It shows the composition of Nigerian exports. And you can see that the Nigerian economy in terms of exports is quite undiversified. And since 2014, when the oil price started to decline, that has an impact, of course. Nigeria's external balance and its budget balance, given the revenues, have been impacted quite negatively. And to reduce these vulnerabilities, the country needs to implement reforms aimed at both increasing revenues, for example, increasing the VAT rate, cutting down fuel subsidies, because as you see, they export mostly crude oil, crude petrol. But at the same time, they import refined products, which are then subsidized to allow the common Nigerian to not to pay too much at the pump, basically. But it costs, of course, a lot of money. And also another reform would be to diversify the economy. For example, recently the government has taken some measures to stimulate other sectors other than oil. For example, solid minerals. But even if these measures are effective, non-oil growth comes from a very low level, a very low base, and as such will not have a noticeable impact very soon. And moreover, the implementation of reforms in Nigeria is a very slow process due to the fragmented political landscape and also the interventionist tendencies that exist, even under current President Buhari. I mean, there were expectations that he was a bit more business friendly, but so far that has not materialized. Moving to the second slide, because I wanted to show it's not just about oil prices, which has come down, but it's also about oil production, which has come down. You can see in the graph the oil production in the last few years, since 2012. And as you can see, it's on a declining trend. And by the way, this is not just since 2012, basically already 20 years in a row. The trend is declining, so there are, of course, some years that are exceptions, but the trend is downwards. You can see that if you look at the peak in production, that was actually in '97, so that's indeed 20 years ago. And this is basically caused, I mean, this trend, by years of underinvestment in infrastructure and also lots of inefficiencies. There is a petrol industry bill, the PIB, that was meant to address a number of these issues and create a big overhaul in the whole oil industry. For example, making it more self-financing and profit-driven. But especially the revenue sharing part of this bill has been extremely difficult to agree on in the current or in the country's political setting. And basically this bill has been dormant in Parliament since 2008, so that's already 8 years, 9 years even. If you look at the graph, the very sharp decline which you see in last year, 2016, that is not due to infrastructure or inefficiencies, but that's due to militant attacks on the pipelines, in especially the Niger Delta. The situation has recovered in the latter half of 2016 after talks with some of the Niger Delta community leaders and repairs, of course, of the pipelines. But since these militant groups are very loosely organized, it's not always clear if the government is talking to the right people. So that's it's always a question if these attacks now really have stopped, or if there is some other group that still feels yeah, they're entitled to a higher share of oil revenues, and as such start attacking again. On the bright side, Nigeria is not is exempt from oil production cuts as agreed by OPEC last year, since it's already far behind on its own production quota. Moving to the next slide. So Nigeria entered a recession. You can see the GDP growth in the graph. Blue is positive and the yellowish is negative territory. And until 2015, the non-oil sectors of the economy were still growing. But in 2016, so last year, these two turned negative on the back of hard currency shortages, high inflation, and also declining investor confidence, which I will touch upon later. The economy entered recession in the third quarter of 2016, with recession, of course, being defined as 3 consecutive quarters of negative growth. Given rising oil productions, as you saw in the previous slide, and also higher oil prices compared to last year, GDP growth is expected to pick up somewhat next year, but it will be yeah, not a massive improvement. Then looking at the monetary policy and the Naira. In the graph you can see the developments in the Naira over the recent years, basically since early 2014. That's of course versus the US dollar. And you can see that when the oil price was still high, the currency was kept stable. And the central bank was allowed, or was able to keep the currency stable with their foreign exchange reserves. And of course with a high oil price and also a high oil production, you earn much more US dollars, much more hard currency, and you can use that hard currency to defend the Naira rate basically. But with both the oil price and the oil production falling and investments also flowing out of the country, the central bank had to devaluate. They first did so in November 2014, then again in February 2015, and then after they kept it stable for quite a while at about 200, as you can see in the graph, the horizontal line around the 200 level. They were forced in June 2016 to, as they say, to float the currency, and you can see a huge devaluation or huge depreciation, 60% even in local currency terms. Floating is in yeah, between brackets or between high quotes basically, because as you can see in the next graph, it's not actually floating, because since June last year the central bank is still intervening in the foreign exchange market. So they said we now, in June last year, they said we now float the Naira, but since then they have been heavily intervening still to prevent further depreciation. Also, in a sense, the Central Bank of Nigeria remains the only seller of hard currency, of US dollars, which create huge yeah, shortages of US dollars in the market. And on top of that, to prevent further depreciation and make defending the currency easier, they took some rather unconventional measures. Like, for example, you cannot use US dollars for importing a number of goods, about 400 goods split into 41 categories. And basically they solved that measure by saying we need to stimulate local manufacturing. which has some effect. Indeed, some of these imports that were previously imported are now produced locally. However, this is quite limited. Also, banks have to disburse incoming remittances in dollars. They have to disburse it in Nigerian Naira and sell the US dollars to change bureaus. Basically, before these bureaus were getting their hard currency from the central bank. Now they get it from commercial banks, if and when available, of course. But that also serves to increase the stock of dollars flowing into the central bank coffers, basically. And the final measure here mentioned is already retracted. But banks had to, for a while, they had to direct 60% of dollar purchases to manufacturing firms, allowing those manufacturing firms to get their raw materials from abroad. But basically, all these measures have their result that there is a huge shortage of US dollars, of hard currencies in the country, and also that a huge portion of the USD demand is not met, and that results that result again in a black market rate, which is much higher than the official rate. The official rate, you could see in the previous slide, is around 310, 315 Naira per dollar at the moment. But the black market rate is way over 460 Naira per dollar, and it has been over 520 Nairas per dollar already. It went down a bit late February when the central bank sold quite a portion of its foreign exchange reserves on the market. But also, of course, a result of these measures is that, and the black market rate, is that the market expects the official rate, exchange rate, to move towards the black market rate. Of course, when the market expects this to happen, they wait with their investments until it materializes. Otherwise, if you would invest against the current official rate and such a devaluation / depreciation would happen, then you would incur already, right from the start, a huge loss. Furthermore, another effect is very high inflation. This is basically due to two factors. One is the lagged effects from the previous depreciation steps, as you could see in the previous slide, but also the huge gap with the parallel or the black market rate results in an upward pressure on prices. Imagine if you cannot get dollars to finance your imports through the official channels, but you have to resort to the black market rate because you just need those imports. And by the way, those imports are not prohibited. It's just forbidden to use the official dollar channels for those imports. But then if you import these materials against the black market rate, then of course you have to raise your prices to make up for this, basically. All in all, these measures, and as I said, the third measure is already retracted. They result in quite an unpredictable environment for foreign investors, which is also shown by the next slide. This is just an illustration of how Eurobond yields are coming down, and Eurobond, as you know, are denominated in dollars. So investors, they look for assets, and in this slide, those assets are bonds in dollars, but they shy away a bit from bonds in local currency, which you can see because the yield on local currency bonds is going up, whereas the yield on hard currency bonds is going down. Just a final slide to recap. So the first bullet point, I think, is clear. The second one, indeed, oil proceeds, both coming from price and production, determined through the FX reserves, which you can see in the right-hand graph, how long the central bank can support the Naira at its current levels. Let's say around 310, 315. You can see FX reserves have been coming down since basically end 2012, but you also see a slight uptick in recent months. It goes till end last year, but you already see that higher oil prices and also the, let's say, the pipeline repair, so a higher production, resulted in a slight uptick in FX reserves, meaning the central bank has a bit more ammunition now to keep the level stable at its current level of 315. But as I said, a sizable depreciation slash devaluation is looming. At the other hand, a change to a full float is probably doubtful. There is within the country a lot of resistance from the political side, especially. But also you could place a question mark on the immediate benefits the country would have from a lower or a much lower exchange rate. As I said in the first slide, the current economic diversification is very low. So in a sense you could say, yeah, people or companies would profit from a very cheap Naira, but if you don't export a lot of things next to oil, which is already dealt with in dollars, then the country would at first or at first sight benefit not a lot from this cheaper Naira. So what you see is basically two separate and two big but separate risks. One is the exchange rate risk, which is of course the risk of a sharp depreciation of Naira, and the other one is the convertibility risk, the risk that because of the hard currency shortage that a borrower is basically unable to convert Nairas into dollars. Even though he has the Nairas, he just cannot convert them to dollars, or more general, that it's very difficult to change large amounts in Nairas into USD and to get them out of the country. There are some partial solutions to these risks, and for that I hand over to my colleague Per. Thank you.
Yes, thank you very much, Jos. Yeah, very obvious. Two major risks overhanging the country and overhanging financiers and borrowers, exchange rate risk and convertibility risk, both of which are present very much. The risk of depreciation is continuing, and convertibility issues are rife in the country, as many maybe on this webinar will know, and many lenders and borrowers have already experienced. TCX is designed to deal with the former risk, so we can take care of currency risk in markets where other banks or institutions are not doing this. So we try to complement hedge markets in developing economies. Convertibility risk, unfortunately, we can't take. So that is very much a problem for which still other solutions are required. One or two other comments about TCX. Because we operate in a undeveloped market, by definition it means that we cannot hedge our own exposure. When we take on hedges, we only have open positions on an uncovered basis, and the reason that that is doable is because we have both very substantial capital relative to the size of our portfolio and global diversification, and the combination of those two makes the model sustainable. It also makes the model very moderately profitable. On average, we make a 1% profit. Exchange rate volatility is obvious with regard to the Naira. Just also wanted to place it in a slightly wider context, and we do that because in a later stage I want to reflect depreciation against hedge cost. This is for the past 3 years the annual average depreciation of a list of African currencies. So it's the Ghanaian cedi, Kenyan shilling, Morocco, Mozambique meticai, the Naira, Tunisia dinar, Tanzanian shilling, Uganda shilling, XAF, XOF, Central African franc, and then we have the Zambian kwacha and the Rwandan franc, and what you see is very significant average depreciations, generally way above 5 or way above 10-15%. Given that volatility, and switching to the energy sector, first a question, where does that exchange rate volatility impact the sector? I just want to make a division there between the on-grid situation and off-grid. Very briefly on on-grid, because I suspect that most people are also very much interested in the off-grid sector. And also in the off-grid, exchange rate risk is faced directly by businesses, contrary to the on-grid environment. As you know, the model there is that the utility buys power from an independent power producer, generally on the basis of dollar PPAs, shifting that risk, shifting the exchange rate risk to the utility, which then deals with it by allocating it to either consumers or taxpayers or the shareholder. Not ideal. Point to make is that the risk sits with the utility. So how to tackle that is very difficult in the absence of full and comprehensive local currency funding options. It's very difficult to disrupt that dollar PPA model. One of the things that you could entertain to support the energy sector is to work with the utility where the exchange rate risk sits in this model, and to see if there are structures possible to hedge the exchange rate risk at that level and to take it out of the host country and put it on the balance sheet of hedge providers like, for instance, TCX. And we've started these kind of discussions, but not yet in Nigeria. A third or a second possible way of restructuring the sector, I just mentioned it, is that if economies would shift from dollar index PPAs to actual local currency PPAs, in that case the exchange rate risk will be passed to the project, and the projects will be required to fund themselves in Naira, either offshore using hedged funding or onshore if banks have the capacity to do that. There is, and maybe some people on this webinar can confirm that later, I think in Nigeria sometimes there's mention of Naira PPAs, but clearly it's not the dominant model in sub-Saharan Africa. Off-grid is a very different situation, as you know. If you're an off-grid, whether a solar home system provider or a mini-grid, you're selling your product or leasing your product, depending on the model, directly to consumers, thereby in principle generating local currency revenue. That's at what we see is at development stage. Businesses are happy to take that risk. Equity providers are also generally happy to take that risk. Of course, when you come to expansion and debt funding stage, hedging and the question should I or not be exposed becomes very, very relevant. When these businesses start talking to lenders, it will also depend on the lender whether local currency is an option or maybe a requirement. But if that choice is there for the business, then of course he needs to make a decision. The off-grid company needs to make a decision. Do I fund myself in local currency at a higher nominal interest rate, or do I leave myself exposed to exchange rate risk, or do I sit somewhere in between? First question that will come up from a borrower's perspective when talking about hedging is of course the cost. I already mentioned the higher nominal interest rate. The statement that local currency or hedging is expensive is generally incorrect and not supported by fact, and this is why I wanted to show that earlier graph. So that comes back here in the blue columns. What we're showing is again the average annual depreciation of these currencies over the past 3 years, and now we've put next to that the TCX hedge cost or hedge rate, I prefer to call it, that was available precisely 3 years ago, or in the 1st of January 2014. So you could have hedged yourself at the level of the orange columns And 3 years later, you could have, in hindsight, determined whether that was purely on a financial expense basis, a positive or a negative hedge instrument, and you would have concluded that for by far most of the currencies in this particular 3-year bracket, hedging the hedge would actually have been a money-making instrument. That is, of course, not the way to look at hedging, but this is very useful to perhaps challenge this generally held assertion that hedging is expensive. It is actually, generally speaking, not so. On average, what you can say, and this is also evidenced by the empirical evidence by our own hedge portfolio. We've done billions and billions of transactions now over 60, 70 currencies, and on average, what you should expect is an equal cost for a dollar or a local currency option. If you take the hedge to the local currency option, you pay a higher nominal interest rate. You should probably also expect to pay the hedge provider a premium. I mentioned earlier that on average we make a 1% premium on the cost on the hedge. But you should compare that to the dollar option. Yes, a lower nominal interest rate, but then you must of course add the expected annual depreciation of the currency that is relevant to you. But on top of that, you should add what creditors will include in their risk assessment of you being an unhedged business. That will inevitably lead to either higher capital requirements or higher credit margins, or a combination. In expectation, therefore, you are equally expensive, while if you take the local currency option, you are of course completely isolated from volatility, currency shocks, and have all the benefits of predictable cash flows. Another way of looking at hedging is not so much seeing it as a financial gain or loss, but really trying to eliminate the red line, which is exposure to daily currency volatility, unpredictability, uncertainty, potential shocks, and replacing that by the green line, stability, predictability, no exposure to shocks, and whether that at the end of the hedge period or your funding period, the green line was a little bit higher or a little bit lower, whether the hedge was a positive or a negative is not that relevant. So in conclusion, we would always argue, especially if you are an off-grid developer, a startup company, that in principle, faced with the choice, do I borrow in hard currency or local currency, you should always be hedged, always take local currency. Now, of course, we know that in reality, a certain business may make a different choice, especially if you're a first mover in not such a competitive environment yet, where you have a lot of pricing power. You could make a decision as a borrower to speculate and take the lower dollar interest rate. If things turn out worse than you had bargained for, you can pass on the exchange rate losses to your consumers. And if not, it's gain for the shareholders, especially if when markets mature, but also maybe for consumer protection principles or competitive reasons. At some point, that is also not the most sustainable approach. And of course, we're talking about Nigeria, so beyond all of these principles, which in principle also hold in Nigeria, we are dealing with a very extreme environment. That's now been pointed out a number of times. Given that environment, just to briefly touch on a few options of how you could potentially hedge yourself. Of course, the first option is that you borrow in dollars and you take that risk. Given the difference between the official rate and the black market rate, that would imply already a quite significant loss up front. You really have to take into account that the currency is already expected to depreciate and you will be exposed to further future losses. You can borrow in Naira from an offshore source, so from an offshore lender who then hedges with us, and I'll speak a little bit more about that. Other options are to borrow in dollars and to hedge locally, and that point has to be made that currently there is a very liquid futures market in Nigeria that uses the official rate, and I mentioned it earlier above in the paragraph above, the NIFEX, which is the official interbank exchange rate. That's also the rate that we use when we set our swaps, and a comment about that later. But that's also the rate that drives this futures market, which means that you can domestically in Nigeria buy future dollars at a relatively low official exchange rate because it's not the black market rate. So that presents currently a potentially attractive way to hedge. So borrow in dollars and hedge yourself in the futures market. The big risk with that is that it is very short term, 3 months, 6 months, so you will always be exposed to interest rate risk with no certainty of predicting how severe that might be. And of course, you can, the third option of hedging yourself is by funding yourself locally in Naira in a domestic market, and something that Dinesh no doubt will speak a little bit about. I don't want to spend too much time with this example. It gets a little bit technical, but I want to make the point that we do support lending, borrowing in Naira. Not a problem. That's something that we can do today. We can offer swaps and we can price them. But the issue with that is that we must refer to an official exchange rate because the black market rate, however real it is, is not observable, and therefore you can't use it to set swaps. And you can imagine, and I won't go into that detail now, but you can imagine that introduces a number of complexities when you are setting up a Naira loan. It can be done, but also there the possibility of the NIVEX converging with the black market rate will present some issues. People facing that situation should always come talk to us to find out how this exactly works. So yeah, and one comment I should make just to show you, confirming here that we can price a Naira loan, we can price a swap, so we can price a hedge in the country. The way we do that is by, in principle, referring to the government bonds and applying a spread above that or under that. The blue line here is the government bonds. The red line steeply dipping down are our hedge rates. And why is this the case? Why is it so much more expensive in the short term? Well, that's obvious because it already prices in this big gap between black market rates and official rate, and the heightened vulnerability of the economy to shocks in the short term. So on that, and while you admire this little image, which we like to use to conclude that local currency is for a real business the superior alternative in principle, I would like to hand over to Loes, who will talk a little bit more about structuring aspects of the local currency loan and the hedge. Thanks.
Loes, the floor is yours.
Thank you. Thank you, Evelyn. Thank you, Per. As Per mentioned, I'm gonna talk about what MFX does in the renewable energy sector, how we can support currency hedging, and how we have partnered with both TCX and with OPIC to provide currency hedging in the sector and to support local currency lending. For those of you who do not know much about MFX Solutions, let me start with a brief introduction. We're a company, we're a dedicated currency hedging facility. We were basically set up back in 2009 with the idea to provide currency hedging solutions in the microfinance sector. Since then, we have evolved and we pretty much now cover all the impact investment spectrum, including renewable energy. Our role is to be an intermediary. TCX and commercial banks are the ones who provide the currency hedging solutions, and they're the ones who offload or manage the risk themselves. MFX does not take the market risk, does not take the currency risk. We offer you access and make it easy for you to access currency hedging solutions in a more affordable way. So more affordable meaning that you can get rid of the collateral requirement. And we do that by partnering with OPIC and with FMO. We get a guarantee from them, which we can post with banks and with TCX. And that way we can work with you directly. We can offer you hedging solutions in pretty much any currency and any tenor without any collateral requirement. That's kind of the advantage of working with the MFX. We are not competitors of TCX. As you can see, we are partners. And I want to just mention that in the Nigerian market, 2 years ago, I was able to get hedges from pretty much any of my bank counterparties without any problem, from 1 month to 2-3 years without a problem. Last year, when we saw a lot of drain of liquidity, when the unofficial exchange rate and the official exchange rate had a huge divergence, we saw that banks were quoting up to 1 or 2 or 3 months max, and TCX was instrumental for us to continue providing currency hedging solutions for our clients. The next diagram will show you a bit better how we work. On the right-hand side, you'll see the energy sector, let's say DESCO solar projects that get all the revenues in local currency, in Naira in this case, but they might be looking for international investors that will give them loans in hard currency. If that's the case, or if it's a fund that needs to secure returns in hard currency, if that's the case, they can partner with MFX, and then MFX will face both the currency risk, which will be offloaded to one of our counterparties, which is either TCX or a bank. Then they'll manage the risk. The banks can just offload it to another bank, and TCX just, with the way that they're set up, they'll do diversification and take the risk themselves and manage it themselves. Then the credit risk, we manage it with our OPIC guarantee, so that means that we post it to bank counterparties and to TCX, and that way we can offer hedges without any collateral requirement. The next 2 diagrams will show the 2 structures that we had set already, and we have actually already have them working in certain markets, and we'll give you an idea of how we have worked and make it efficient and make it work for this market. So on the right-hand side, let's say there's a DESCO or a solar project, and there's a renewable energy fund that will give them a local currency loan. Then the DESCO or the solar project does not have any currency risk. The fund is the one having a currency risk if they have to secure returns in hard currency. They can partner with MFX, do a hedge if they think that they don't want to keep the currency risk themselves, or they don't want to manage it. MFX will offload it to TCX, and MFX can provide actually a hedge and not ask for any collateral. The next structure is a partnership with OPIC, and I know Suba will talk a bit more about the different ways in which OPIC manages risk, but this is just a kind of a new structure that we set up. If OPIC is giving a loan in hard currencies or in US dollars, and they identified that the DESCO or the solar project just can't hedge themselves in the market because there are no alternatives, so as Per mentioned, maybe there are short-term alternatives, but there's a high rollover risk for them to just do a hedge for a short tenor when the loan is maybe longer or way longer than the hedge. Then the MFX can come and work directly with the DESCO, provide the hedge without requiring any collateral, as long as we get a credit guarantee from OPIC. And the credit guarantee that we're talking about is pretty much it's pretty much explained in this box here. Is just including a clause in the loan agreement that says that the swap has seniority over the lender in the cash waterfall. These are the 2 most important structures that we have come up with to work in the renewable energy solar sector. and we encourage you to take a look at them to see if you can work with them. There's one risk that we still cannot hedge, and it is the convertibility risk that Per mentioned before. That's something that prevails in the Nigerian market, and that is a challenge. And as I know we have a very ambitious agenda, I'll stop here and let Suba take the stage now.
Thanks, Liz. I'll go ahead then. For those of you who are not familiar, the Overseas Private Investment Corporation is the U.S. government's development finance institution. We mobilize private investment to address development challenges and stimulate economic growth in emerging markets by providing primarily debt financing, political risk insurance, and we also support private equity investment funds. Our portfolio in sub-Saharan Africa alone is $6 billion, representing almost a third of our global portfolio. And since our inception, OPIC has provided, or since its inception, forgive me, OPIC has provided almost $2.2 billion through Power Africa, establishing the agency as a leading lender to the energy sector in Africa. As far as our view on Nigeria and our role in Nigeria's energy sector, we are one of 15 lenders to the 450 megawatt Azura Edo thermal IPP, which reached financial close in 2015. And we currently have a pipeline of about $1 billion of potential financing to support both grid-connected thermal and solar IPPs in Nigeria. We have also supported off-grid solutions, most recently providing financing to support the Novolumos transaction, which is a solar home kit solution that uses a pay-as-you-go mobile payment system. And as Per mentioned, the way we approach currency risk when we look at off-grid and on-grid connected projects is sometimes varies. As far as our view on what foreign exchange risk looks like in Nigeria, one of the largest challenges for lenders to the energy sector in Nigeria currently is basically the financial insolvency that we see, some of which can be attributed to the exchange rate depreciation that's been experienced since 2014. For example, during the privatization, most discos borrowed in dollars to finance purchase of assets. At least 70% of disco and wholesale energy costs are dollarized, and generally 90% of costs throughout the energy value chain is dollarized. And this basically means that the amount of nominal Naira required to bring or realign energy sector fundamentals to bring back solvency is huge, in light of the fact that while these costs are going up, the tariff that is currently in Naira is effectively been depreciated in real terms, and so that levelized cost is not able to sustain what the sector needs. As far as the next slide, what we do in terms of our own hedging strategy, I'll just briefly mention is that look, we only have the ability as OPIC to provide dollar-based funding to any of our transactions, and so we can either allow the project to take the foreign exchange risk on its books, which we indirectly pay for at any rate. We can either try and hedge our own books, or we can just take a view of, given that we're lending throughout the world, to allow the various long-term positions we have in various currencies to offset each other. And generally, the challenge we have in trying to hedge our own open positions is some of the markets we work in, it's very difficult to find a counterparty to provide that hedge just because of the liquidity, and this is why we turn to providers like TCX or MFX solutions to try and intermediate. Otherwise, again, I would say markets where alternatives to dollar funding isn't clear. On the next slide, the way we use creative financial structures, which, again, we don't have many that we can use from our own books, but we do have two that are worth mentioning and very much mimic what was walked us through with the MFX provider. Essentially, we have the ability in certain cases to guarantee eligible financial institutions to provide the local currency liquidity while we underwrite the credit risk. So whether it's MFX, whether it's a local financial institution, we essentially come in, identify an eligible project, we will do our full due diligence, underwrite the credit risk, and essentially the intermediary will therefore fund the will actually fund our position in local currency and does not take any credit risk. We generally size a certain appreciation cover into the amount we approve for the loan so that any currency fluctuation up to, I would say 2x volatility, we will take on our books, and thereafter the intermediary will take any exposures that go above the 2x volatility. And then the last slide basically just outlines in a little bit more specificity how exactly the guarantee structure works, which I'm happy to take more questions on if we get any later on. Otherwise, I'll turn it over to Dinesh.
Excellent, Dinesh. We still have a poll question. Would you be interested in the results? So as you can see, around 17% of the attendees have answered that, if they are considering local currency debt financing for a project in Nigeria. So 17% says, I'm actually considering it. 56% said I would theoretically consider it, and 28 is saying, nope, I won't do this. Then I will turn it back to your presentation, Dinesh. Go ahead, the floor is yours.
Thanks, Evelyn. Those results are very interesting. I'm actually heartened to see that the results are higher than I expected for local currency. And hopefully if you retake the test again by the end of the presentation, we'll see them increase even further. So starting off by giving you a view on Goranko, and what we're looking at in Nigeria at the moment, everyone's talking about is convertibility risk and FX risk. And the most straightforward, natural solution to both of those is raising your debt financing in local currency. And that is what Goranko is designed to do. We are the only DFI purely focused on supporting local currency financing in support of infrastructure development in lower income countries. We were set up by 5 OECD governments, namely the UK, the Dutch, the Swiss, the Swedish and the Australian governments. And we're really there to bridge the gap between supply of local currency and demand for local currency. And it's not only through our products, but it's also through our institutional knowledge and ability to support and educate stakeholders in the process. I should say, although we are a DFI, I'm quite proud to say we have a track record in which we move faster than commercial banks. So we're a very quick partner to join up with in transactions. So our primary aim is to crowd in the private sector. Ideally for us, that's the domestic financing parties, be the commercial banks or ultimately the pension funds and insurance funds. And what we're aiming to do is build self-sufficiency in these markets. So long-term infrastructure requires long-term local currency financing, and if we can set up mechanisms to get ultimately the natural sources of this financing, that's the pension funds and insurance funds, to fund the infrastructure, we've got a self-fulfilling cycle here. And it's probably worth mentioning InfraCredit, for those of you who haven't heard of it, is a Nigerian-focused credit guarantor focusing on exactly that, mobilizing pension fund investors to support infrastructure in Nigeria, and Goranko was a founding co-sponsor of that. We are rated AA- by Fitch and A1 by Moody's, so we are a very highly rated credit, and that helps our counterparties accept our guarantees in transactions. So I thought I'd discuss the broad solar financing options that we can provide, and they're broadly split between the on-grid and larger off-grid products and the home solar and off-grid areas. So on the on-grid, in your traditional project financings, we can provide partial credit guarantees to support commercial banks to provide local currency financing for projects. So the guarantees can help to overcome simple obligor limits or sector limits. They can also help to stretch out tenors, and even provide help banks to overcome liquidity constraints. So we can structure liquidity put options, which kick in at the tail end of loan transactions where lenders cannot fund for the last few years. We also provide contractor guarantees, and it's really a form of bridge financing. So if the project needs to move ahead of senior debt reaching financial close, and we have a positive view of the project reaching financial close at some point, we're happy to provide a contractor guarantee to the EPC contractor, which helps them to defer payments and effectively constitutes a vendor of bridge financing. And the aim is during the construction period that senior debt comes in and refinances the bridge financing, and it gets a need for our guarantees. We can also support corporate and quasi-corporate financing, and examples of that are, credit-enhancing corporate bonds. We're looking at supporting solar developers who are issuing corporate bonds at the holdco level to fund their development activities across Africa. And moving on to the smaller off-grid and solar home solutions, even more in this area, local currency financing is critical because you don't have PPAs with a utility that are pegged to the US dollar. It's totally local currency, and the risk is completely unhedged here. So we can help in a couple of ways. One is through capital markets, where we look at supporting corporate bonds and securitizations, and we can look at more structured guarantees that take first, second, last positions, and more non-vanilla structures. And we can also support direct lending to these companies. And local banks typically find supporting off-grid solar more challenging because the companies are typically younger, have a limited track record, and local banks don't have the experience to analyze these risks. So our guarantees can help to overcome these limitations, but also reduce the need for cash collateral, which for these young startup companies is critical for their funding their growth. We can also look at supported trade financing, so inventory discounting and vendor financing. So just to close, I thought we'd summarize on a high level what we're actively looking at in Nigeria at the moment. We are helping one of the more advanced solar projects in Nigeria overcome some of the market constraints through the use of a contractor guarantee to help them to meet deadlines under the PPA. In the longer term, we're also looking at options for supporting local currency bonds to help refinance solar projects that have reached COD. And we're working with InfoCredit on this. And it's going to play a big part in getting the pension funds actively involved in the sector, and we see that as a long-term funding strategy for IPPs in the future. And in the off-grid, we're looking at some home solar businesses and helping them to access long-term funding from the banks. So in a very, I wanted to leave you with a few takeaway points, and our view is this: we need to try and move from hard currency or unhedged hard currency positions to hedged or truly local currency solutions. And it's going to be a process, but we need to educate. It's an education, and we need to educate the off-taker and make them understand that higher tariffs in local currency are actually stronger than hard currency linked but lower level PPAs, because they don't have the hidden costs of FX and convertibility, and they're more sustainable in the long term and more beneficial for the end users. We think developers that can think outside the box, particularly in Nigeria, are going to be very attractive to NBET and position them well for long-term strategies in developing multiple solar portfolios in the country. And cognizant that offshore investors need to hedge their risk in terms of dividends, and we think there are solutions there that can be discussed with other entities such as TCX. But in summary, long-term currency financing is key for the long-term viability of the power sector in Nigeria. Thank you, and I'll pass back to Evelyn.
All right, thanks to all the panelists for their valuable and interesting contributions. I'm moving directly to the Q&A session. For the audience, you can keep asking questions via the chat box. It says questions on the right-hand side. I would also, we will be joined for the Q&A by Philip Skinner, who is also a Senior Investment Officer at Garanco and will be teaming up with Dinesh to answer questions on Garanco's side. I think one of the first questions can be directed is for Per. Per, if the Nigerian government wants to support local renewable energy markets in their business, to what extent would the Nigerian foreign exchange reserve play in doing this? Or can Nigerian renewable energy marketers just seek international insurance companies that will be willing to do this hedging?
Could you? Sorry, Evelyn, I missed. Yeah, I'm going to ask you to repeat that because we missed the first part of the question.
Sure, no problem. If the Nigerian government wants to support local renewable energy marketers in their business, to what extent would the Nigerian foreign exchange reserve play or have a role in doing this? Or can Nigerian renewable energy marketers just seek international insurance companies that will be willing to do this hedging?
You're hearing a few terms come through here. The Nigerian foreign reserves was mentioned. I guess the relevance of those reserves I don't see directly to the renewable energy sector development, but I guess they are critical with regard to maintaining some kind of stability in the exchange rate, in the absence of which developing renewable power projects on an unhedged basis becomes increasingly hard to do and high risk. And then there was a question about what foreign institutions can do to hedge. If I understand the question directly, renewable energy projects that cannot be funded domestically in Nigeria because of the limited capacity of the banks or otherwise, and therefore rely on external funding. The point there is that there is a relatively liquid offshore non-deliverable forward market, so a hedge market. People like Citibank and Standard Bank and JP Morgan, these are all banks that provide hedging, but generally shorter tenors, and not everybody can get access to those hedge products. Citibank doesn't deal with everybody in the world, and volumes may be limited, etc. And to the extent that that falls short, TCX and MFX can step in. We have the capacity to provide hedging up to 15 years fixed rate, no problem. So we can support, with our product, we can support basically any kind of tenor funding denominated in Naira to renewable energy projects. The only issue being that, as mentioned before, there is this difference between the official rate and the black market rate, and that produces complexity in structuring the product. So I hope that sort of provides some answer to the question.
Yeah, it's a complicated question. If it's, I hope also that it's clear, and if not, I'm sure we'll see something come in via the chat box. I have one other question for you, Per, from Demi Adesina from Rensource Energy. At what scale of a hedge is it affordable to hedge against Naira and US dollar risk with the difference in official and parallel market rates?
Well, the volume itself for us as a hedge provider in Naira and for MFX as an intermediary hedge provider is not really a constraint. We do very small deals, 500,000, even less, and especially if there's a prospect of having a long-term relationship, the size isn't really a constraint.
All right, clear. Suba, I also have a question for you, from Mr. Adesina. Are there specific banks you have already worked with or you understand are interested in financing distributed solar projects with open credit risk sharing?
No, thanks for the question. We have not partnered with any financial institutions in the off-grid space. We have provided sole financing in those cases, and they have been dollar-based.
All right, clear. I have a question for Garanco. How does one engage you in conversation? In particular, if there are local banks we are in conversation with who would be more amenable with a Garanco guarantee, and added to that, do you also provide guarantees for external foreign debt providers?
Hi Evelyn, it's Phil here, so I'll take that one. Yes, so look, we are already in conversation with a number of the local banks in Nigeria, so hopefully they're all relatively familiar with our product. Indeed, we've actually written some guarantees with them already, and I guess further to that, with our new vehicle InfraCredit, which is a joint venture between Garanco and the Nigerian Sovereign Wealth Fund, the NSIA, our presence in the market is increasing. So, you know, we're very happy to join conversations that anyone on this call might already be having. Hopefully our details can be circulated after this call, and it's hopefully, as I say, not going to be a conversation starting from scratch with the Nigerian banks. The second part of the question was on external debt providers. Could you maybe clarify that one?
Yeah, the question is just, do you also provide guarantees for external foreign debt providers?
Yeah, sure. So Garanco's focus is on local currency and local capital markets. So in terms of, we partner with sort of regional and international banks who are looking to provide local currency into places like Nigeria. In some countries which we term as fragile and conflict afflicted, we do have the ability to also guarantee some dollar financing, but that's only in specific circumstances and not something we'd be looking to do really in Nigeria. We have, it's probably worth just being clear that we have little or no capacity to offer guarantees to other DFIs, however.
All right, thanks. I have one, I think, more practical question for Garanco as well. I have a question or person saying, we find the products of Garanco interesting. What are the requirements for trade financing?
So typically Garanco is focused on long-term, supporting long-term financing. We have had instances where we support trade financing in conjunction with long-term financing packages. So yeah, the situations we come across are quite bespoke. So what I'd say is get in touch with us with the specific requirements or problems that you have, and then we can assess very quickly whether we can help you and what kind of solutions we can provide.
Yeah, I will be sure to be circulating your details when distributing the proceedings as well. I have a question more on the Nigerian policy. So anyone who feels that they can answer this question, go ahead. Solving the issue of convertibility is key to increasing the investability of the Nigeria in general and the solar space specifically. Are there any policy changes anticipated that will allow for convertibility in this sector?
I'm happy to take a portion of that question. We were recently in Abuja discussing with the Deputy Central Bank Governor on some of the policy tools that they plan to implement going forward. Now, I mean, to the question of, convertibility, which is really, as discussed at length, based on access to foreign exchange, I don't believe that there will be any, preferential treatment or, let's say, priority given to energy projects, let alone solar energy projects. But certainly in terms of overall priorities for the government, energy is one of them. So one would expect that making good on, payment obligations to energy or GenCos, if you will certainly be something considered in that availability question.
All right.
Evelyn, this is Jos. Yeah, I think it comes down to market forces. I mean, currently you see, of course, that the supply of dollars in the market is very low because the central bank and basically also the government wants to keep the exchange rate stable on basically a too high level. So once you release that and you really let Naira float, then the supply issue will be repaired. But it, of course, comes at a cost, meaning that the Naira will then depreciate to a huge extent, let's say to 500 or even higher, given that the current demand for US dollars is basically, yeah, you could even say almost unlimited. So people are really looking for dollars. So as soon as you let the exchange rate float, the exchange rate will shoot up. And as I said, in the current state, there are senators in Nigeria that say we have to repair this gap between the official exchange rate and the black market rate. The thing is, they don't really mention how the central bank should do that, and the only real solution would be to float the currency. But as I said, in the current state of the economy, the country will not benefit a lot from the onset of a cheaper currency. Normally, a country would see its export increase, given that the currency becomes cheaper. It has been depreciating. In Nigeria, given that the export is mainly oil, which is priced in USD already. So an increase in oil exports would not be visible probably. So it would take quite a while for a floating regime to have any positive effect on the currency, and that of course is also known in the Nigerian government. So I think for the time being, central bank will as its FX reserves allow them, they will just defend the exchange rate, and suppose the oil price would drop all of a sudden, they would not be able to defend it, but they would just probably let the Naira depreciate or devalue to a higher level and then try to defend it from there. So a real float, I don't see it happen in the coming let's say months or years. Thanks.
Okay, we're moving towards the end of the webinar. I still have one or two questions. Perhaps this one is best answered by either MFX or TCX. Could you please provide an example of a country that has experience in local currency risk financing for solar? One that is comparable to Nigeria, to what extent that's possible?
Yeah, this is Per, and Lucia, please add if you wish. Well, where we see, well, in East Africa, the off-grid solar industry has really gained a lot of traction, and it's at a pretty good pace of development. And we now see a number of institutions or businesses that are at expansion, serious expansion stage, and they need to debt finance that. What we've seen is that most of that initial debt funding has come in dollars, but we've also seen examples of local currency finance. And of course, one of the big players in the East is M-KOPA, which is very much a Kenyan-based institution, has financed itself substantially on the domestic market, but has now also reached to external funders, and that funding has been coming in Kenyan shilling, and that has then also been hedged through MFX with TCX. and one of the first securitization transactions, or the first in the sector, was undertaken by the firm Bbox. So they set up an SPV, sold a portfolio of customer receivables to the SPV, which issued a bond, which was then bought by Dutch investor Oiko Credit, and that was also denominated in local currency. So there are a number of examples of local currency finance to the sector already, and yeah, I think what we will see that as the sector matures, the environment becomes more competitive, and the ability for businesses to offload risk to consumers through higher prices, that the exchange rate risk will be increasingly borne by businesses themselves and by extension lenders, and I think we'll see a greater push towards local currency. Thank you.
Yeah, I mean, if I might just say something, as per said it, like I think in Kenya it has the off-grid sector has been taking off, and it has a very prominent role to play in the market. We've seen also Uganda and Tanzania being markets in which we see a good effort and a lot of movement in the off-grid sectors, and we see that mainly they get a lot of international funds, so there's a need for currency hedging, and we'll be participating, and we've been present to support that.
All right, then just a last question, very more general. So whoever feels that they want to take this one. So the focus has been on debt so far. How about equity? Is there any cover for equity?
Yeah, this is Per. I think I mentioned earlier that what we see, what our experience is that equity providers, so businesses that are not yet funded with debt, are generally happy, or not happy perhaps, but willing to take exchange rate risk, even though in principle also equity can hedge itself in a situation where you have a business with revenue streams but no debt to service yet. You could hedge your revenue streams. It's slightly, it's never a perfect hedge because you have unpredictable cash flows, but it can be done. But our experience is that, and we also understand the rationale for equity investors, our experience is that that in general does not happen. And I think also in general it's probably true to say that hedging of equity, there's plenty of good reasons not to do it while in a sort of general operational phase. Hedging of equity becomes very important when you're talking about exits and things like that. Yeah, so equity can hedge itself. There are products for that, but we in practice don't see demand for it.
All right, thanks. I think with that it's time to wrap up the webinar. Thank you all for your attendance and engagement. The webinar recordings plus the contact information will be made available and distributed either today or tomorrow. I really do hope to welcome you all in Nigeria at the end of April. And just again, one reminder, as I've already said, our Naira payment gateway is up and running, so local payments can now also go via Simple Pay. All right, thanks everyone, and see you in Nigeria.